When planning for your retirement, there could be many challenges to overcome. The stock market can be volatile. Bonds don't deliver the returns they once did. And we're all living longer, so your money must last longer. Mix in inflation, higher taxes, and healthcare costs, and you'll see that retiring comfortably could be more difficult than ever. The good news is that there are many financial tools available to help you reach your retirement goals. One powerful option to consider is fixed indexed annuities, or FIAs. But you may be wondering exactly what they are and how they work, so let's take a look. With fixed indexed annuities, in up years, you'll receive a percentage of the market's gains. The better the market performs, the higher your potential returns. But perhaps more importantly, if the market suffered a huge loss, like in 2008, your principal and previous interest would be protected. No matter how the market performs, you cannot lose your principal nor your previous gains. To illustrate further, let's look at a 4-year hypothetical example. In year 1, let's say the market gains 10%. Money that you had put in indexed annuities would earn a percentage of that gain. Let's say in this example that the insurance company capped the FIA participation at 5%. Now imagine during the second year, the market suffers a huge downturn. Let's say 30%. Ouch. In a typical 401k or IRA, you could have substantial losses. But in this example, your account would not lose a cent. The reason? Because the overriding characteristic of fixed indexed annuities is the ability to protect your gains. Even though you wouldn't have earned any additional interest in a down year like this, both your principal and the 5% you earned on it last year is untouched by the market's downturn. Now let's imagine that in the third year that the market came back and earned 5%. Accordingly, the company would credit you with interest again. As before, since our hypothetical cap was 5%, you are credited with the full 5% interest. In the fourth and final year of our example, imagine the market went up 15%. You would once again receive the interest cap of 5%. So at the end of our 4-year example, you can see that your account was both protected and earned a return that was not subject to large market fluctuations. In fact, at the end of the 4-year period, your account had earned a little more than 15% because the 5% that was awarded in 3 of the 4 years was compounded. In our example, it's important to note that if you were invested in a traditional 401k during this period, by the end of the 4th year, your account would still not have even recovered your lost principal, much less the significant interest awarded. So there you have it. The benefits of saving retirement dollars in fixed index annuities could be substantial. In short, by accepting a cap on possible market gains, your exposure to risk in the market is minimized, and your ability to earn a competitive interest rate on your dollars is enhanced. For more information on fixed indexed annuities, or if you have any questions about any other aspect of crafting a customized retirement plan just for you, contact us today.